Good morning, everybody. Welcome to See the Futures. My name is Jim Cagnina with NinjaTrader. Today is Wednesday, January 18th. We have a great show lined up for you today. Before you go too far, I do want to remind everybody, trading futures, options on futures, and about substantial risk of loss, and that's suitable for all traders and investors. Oftentimes in futures trading, you have a high combination of leverage and volatility. And although that could be an equation for opportunity, it's also an equation for risk. So be careful. Only fund your futures trading account with risk capital. My personal definition, money I can afford to lose, doesn't change my lifestyle, lengthen my retirement horizon, or overly stress me out. We make bad decisions as human beings when we're under stress. So be in a good spot there. Easy on the day trade margins. You get plenty of leverage trading futures as it is without maxing out on that day trade margin on a regular basis. Use them gingerly and wisely. We'll be looking at a real-time simulated live NinjaTrader trading platform today. And past performance is not indicative of future results. Keep that in mind. Feel free to participate in the chat. If you have some questions, we'll try to get them to our guest, our very special guest. Jim Urio is with us today. Futures Path. I'm sorry, stumbling. Futures Path. What do you call those things when you listen to them? Podcasts. There we go. TJM Institutional Services, contributor all over the place for all things futures trading, including at the CME website as well. So, Jimmy, thank you for being here side by side with me. Greatly appreciate it.
Thanks for having me, Jim.
Awesome. So, today's description started as, is portfolio rebalancing, and let's talk about that a little bit before we get into, really the meat and potatoes of the news that came out today.
Okay, so this is an interesting topic to me, and which is normally not interesting. Portfolio rebalancing. It should just be almost a machination. But BlackRock and Goldman have disagreed. Both issued statements, and I can't remember which is which. BlackRock, I believe, said the whole 60-40 thing is dead. Goldman says it's not. And it got me to thinking, which I think something is very, very interesting, because 60-40 obviously didn't work in 2022. It got pummeled, right? And that's because the reason stocks were falling is because the Fed was forcibly pushing your bonds down. So, I mean, those are the two things in your portfolio. So the question becomes, in my mind, how do you avoid that? Well, here's my answer. If the years leading up to 2022, you were buying bonds that were yielding 1/4 percentage point, you were bending down to pick up nickels in front of the steamroller, like we always talk about with selling the teenies. So it should have been when rates are below a certain level, when they're not compensating you for risk, that it should be 60% in stocks and the 40% in cash, which I kind of assumed most people were. I don't, and I know pension funds have to buy bonds, things, but now the question becomes, is 60-40 alive for 2023? I think, of course it is. The only time it's a terrible strategy is the one in which we just described it, where rates have to go higher and they're being forcibly pushed that way, not just on the short end by the Fed, but also on the long end with quantitative tightening. Does that make sense, Jay?
Yeah, no, it does make sense for sure. It's the thing that I'm hearing more and more though now is, hey, this is the year of the bonds, right? This is the year of the bonds. So, 60-40 growing up was the rule, right? Especially for passive investors. Now, could it go the other way? Could it be 60-40 the other way?
Sure. Yeah, I think it definitely could. But one of the reasons we do the 60-40 is not for the specific year, just over time for us. But absolutely, when all of a sudden, I was at the investment conference, the New Orleans Investment Conference a couple months ago, and I remember when Peter Bookbar was sitting on a panel next to me, and he started talking about his buying 2-year, and I was like, it struck me as so odd, because in my almost entire adult life, nobody bought 2-year for the 4% return. People bought it for bonds if they thought they were going to go higher or lower. But I'm like, wow, all of a sudden they've become attractive compared to a lot of things, particularly like when you got 5-year tips telling you that inflation, 5-year break-evens, inflation expectations are 2.2, and you can get that 5-year bond for, I don't want you to put the 5-year up, but let's just say, high 3s. To me, that seems like a good place to buy it. And is that going to attract cash going forward? Probably. So I would think people will be buying bonds and force the prices higher and the rates lower.
Right, and at a certain point, that equilibrium turns again, right? With the inverse relationship between interest rates and price, right?
Right, and that's the way it's supposed to be, and that's obviously not the way it was in 2022, because it was a bit of an anomaly that was obviously, again, I'm on here railing about the Federal Reserve and how terrible they've done. And I'm going to continue doing that. It's like scratching an itch. But I will say, and I just tweeted this before, I don't know if you saw it, if you just measured Jay Powell's performance in the 10 months from March to now, I'd give him an A-. Of course, it's very difficult to erase the previous years where he created this mess far beyond where he should have. But I almost forget what the question was when I start the ranting.
Yeah, no, that's okay.
To
That's
your
okay.
point, there should be that relationship between bonds and stocks.
I'm more stunned. I'm more stunned now than I was at the introduction with you saying Jay Powell gets an A minus. So.
Can we when this goes live, let's cut that part out. I don't want to give him any credit. Oh, it is live already? Oh, crap.
No, but more and more people are talking about threading the needle, and I don't know, maybe we will, maybe we won't. Who knows? And we had a little bit of a peek at some key numbers today, right? We had retail sales, which again, it's an important number. We all look at retail sales, and it's not inflation adjusted; it's raw data, and it was a miss.
Yeah, it was definitely a miss. Everything came in slower than you said a second ago about threading the needle, which I thought was a absolute impossibility. Prior to today, prior to the last couple of weeks. Now I think there's a chance. By the way, I don't think it's a great chance that we have this the mythical soft landing. Only I'm judging that in the fact that we've never really been able to engineer that in the past. But today was a miss. The fact that PPI is still trending lower. Retail sales, like I would love to believe that inflation is coming crashing down while other things are holding steady. Now the labor market still seems to be holding in okay. But the consumer is starting to run out of wallet. I mean, you've seen credit card balances have gone way up. At the same time, consumer savings has gone way down. Now, this retail sales number comes in at a negative 1.1, much worse than expected. And keep in mind that in these inflationary times, it should be higher because of it. So there's a factor of that as well. So that was a bad number. So do I think there's going to be a recession? Yeah, I still think there's going to be a recession. But do I think it's going to be a little bit more a little bit better than it could be? Yeah, that's what I believe.
All right. Well, I'm kind of leaning towards you as well. When I saw the PPI number, I felt that it was almost perfectly consistent with what you would expect the trend to be over the last couple of prints, which folks seem to have an opinion that, yeah, that's what it should be. And there's not going to be a surprise here.
Right. And I think that inflation, remember, when inflation was skyrocketing, there were several things that were going to address it. Remember, one thing we always say is high prices are sometimes a cure for high prices. The Fed going at it real hard, supply chains easing up a little bit. And all three of those things are kind of coming together at the same time. I think I remember saying this before, and it takes away the need for the Fed to tighten more. If the federal government, when you look at the last CPI where it was food and energy are still stubbornly high, and those are the things that are the least interest rate sensitive. When you want to talk about real estate and new cars, those things are all very, very rate sensitive, and those have come off quite a bit. So now if the government is wise, they will focus on deregulating in the food and energy industry and trying to get prices down over the long term that way. Spoiler alert, they probably will not.
Yeah, at the risk of sidetracking us a little bit, now that we're talking about consumer debt, the conforming mortgage loan maximum went up 12% to over 700,000. And when I bought my first house, it was like 400,000, right? Yep. And now conforming loans are 726,000 on average, right? There's some higher income areas where it's going to be a little bit higher than that. But what that's telling me is now there's even more debt capacity from the lender's point of view in an already bad situation when everyone's kind of leveraged up.
So what you're saying then is everybody's leveraged up in that space, and we could, if rates stay high, we could be setting ourselves up for a nasty pullback in real estate. That's what you're saying, right?
For sure. Yeah. I mean, you have credit card balances high, you have car loans high, you have all this stuff coming, interest rates going up all across the board for the average person. Now the lenders are going to say, hey, we could give you up to 726,000. Say, please borrow more, which is kind of crazy, I think.
Yes. And I think your viewpoint is completely reasonable. The one thing I will, guys our age went through the 2005 to 2009 period. And one thing that was different is that there was decades of excess built up as far as who was holding the homes. I think it's slightly different now, but to think that we could have a 15 to 20% pullback in housing prices, I think is perfectly reasonable. I agree with you.
We'll see what happens. Very interesting times for sure. So let's talk about some key markets here in light of all of this information. And I kind of, I wanted to, hopefully we could start with the Euro FX, if it's okay, Jimmy, because we had, again, I think we're in rally mode. I think we got our rally cap on. I think there's going to be a more hawkish flavor over in Europe than here in the US. And we have some nice patterns here on the chart.
So I will say this is that the euro is the number one thing I'm looking at for clues to all these other markets right now. One, because I really find the pattern interesting. 2 outside days in a row. Yesterday, an outside day down. Today, what's looking like it could be an outside day up, although it's losing some steam. But here, I think it's a perfectly easy roadmap. If we have an outside day up today, like it's shaping up to be, and then we have strength tomorrow, to me, that'll be an absolute green light that the move higher is completely intact. I think it could, if we extended that trend line up, make for that target, which is significantly higher, a couple percentage point move. We had pretty much the same thing in copper yesterday. I don't necessarily want you to put the copper chart up, but an outside day up and then a continuation today, and that just green lights everything because almost all the things we are looking at are dependent upon the dollar and what we perceive Fed policy is going to be going forward. And the euro is a perfect representation of that. I don't like to look at the dollar index as much because to me it's hard charting something that has all these different inputs, because I think a purer way to get the momentum of the person that trades it is a one-to-one. Have you ever thought of that before too? Like in ETFs and in things where there's multiple components. To me, I think the chart itself, the validity of it is lessened a little bit. Do you agree with me?
No, I agree with you too. The dollar index, it's mostly euro yen anyway. So it's almost like
right.
it's like a tripod. And so that kind of confuses matters. I agree with you 100% on that.
Right. And looking at the euro, then the euro is also highly correlated to the Swissy, highly correlated to the pound as well. So pretty much if you look at the euro, you're getting a pretty good flavor for the dollar index and you're going to a one-to-one comparison. But anyway, if we see a trade tomorrow above that high for today, above that wick, to me, it green lights everything, and not just in currencies going higher, in the metals going higher. Last time on this show, 2 weeks ago, I'm pretty sure we talked a lot about the metals. I hope we did, considering that's my biggest position. I've been tweeting about it for 3 months. But since that time, copper's up 16% in 2 weeks. Gold is up almost 5% in 2 weeks. I haven't checked silver today, but I assume it's following a little bit. It had been a little bit of a laggard. But all those trades are the same thing. If the dollar weakens, meaning if the euro's stronger, I think it green lights a lot of stuff.
I hear you. I'm bullish here in the Euro FX. I'm going out on a limb. But the other market that I thought was really interesting that I wanted to get your opinion on was the 10-year notes. Now, I know we do a lot of stuff with the 2-year yield, but I thought we had a really nice kind of potential breakout pattern here in the 10-year notes, which is probably a little bit of a relief to Chair Powell and everybody else to see this kind of, the yield curve kind of maybe aligning a little bit better.
Yeah. Well, so when I look at the 10-year, and I love, if you take the 10-year in a vacuum and you look at that breakout today, I absolutely love it. And I think that means it heads higher. And again, I'd like to see a little bit of confirmation tomorrow with the trade, but I think we are out of that range for now. And what's the level on the 10-year right now?
Right now, we're trading at 115.20.
Oh, you're looking at this is the So
10-year.
Good.
Yeah.
10-year.
I'm sorry. I was looking at price. I'm sorry.
Perfect. No, that's good. So what yield does that correspond with? Do you have it in front of you real quick?
No, but I can. Hang on a second. We can do that.
Because what I'm going to say is, and you guys have all heard it from me before, 10-year particularly likes big, round psychological numbers. So if yields are heading lower in the 10-year, it's the same exact pattern. It just breaks that spot lower. And now what are we at? 360, does that say?
No, 340.
Oh, 340. So we're below 3.5. So you know what I'm going to say is my medium-term target is going to be 3.25 in the short term and perhaps 3 even in a longer term. To me, this seems like a pretty significant breakdown of yields. And we talk about it on this show, and I'm going to reiterate it just because I think it's an important point. It's not just psychological level. Those big round numbers have this magnetic power because of all the options that are written and bought at those prices. So I think that they're very, very important to watch. So I think if we continue weakness today, a little bit more weakness tomorrow, I think 3.25 is in the cards pretty quick.
Yeah, I'm looking at this not as a double bottom. I'm looking at it as a breakthrough as well.
Right. Yeah. Okay, good. Yeah.
All right, all right. Yeah, so inverse relationship is perfectly aligned on the charts for
Yeah.
sure. Let's take a look at gold. You mentioned gold, right? Gold is on the
Yep.
move. I don't know what this line is here. This line was from the highs in June. I don't know how valid that is, so I'm going to get rid of it. But we're right
Okay.
there anyway.
Yeah. But I think that line does come into play a little bit. If we
Yeah.
so last 2 weeks ago on the show, we talked about that shaded area right there, and a settle above it, green lights it. It worked beautifully. Again, metals are some of my biggest holdings right now. I've been screaming about them for several months. The fundamental thesis was a weaker dollar as the Fed was nearing the end of the cycle. The thesis for copper was, China reopening. The thesis for gold was the dollar, coupled with the fact that Bitcoin and Ethereum have had a bit of a difficult time being a safe haven, although both of them recovered quite nicely. So anyway, the gold trade worked well. Now, the reason I like that line being drawn back in from those June highs, because it's a similar pattern to the euro. Surprise, surprise. We just kind of said that, in my opinion, everything is trading in lockstep with each other. But an outside day today and then another trade higher tomorrow, I think it green lights it, and that becomes support, significant support, that line. What are your thoughts on it?
Yeah, well, overall, and again, I'm not a Peter Schiff fan, but I am bullish on gold as well because of the dollar, right? These things have been
Yeah.
such negatively correlated in recent time, and they're not always that strongly negatively correlated, but they have, and I think that's going to continue on through this calendar year, which begs the question: are we going to go back to normal correlations across all these asset classes in 2023, or do we got to wait till 2024?
I think we got to wait longer. This is Larry Kudlow and I have been having this argument for several years where he says that profits are the mother's milk of stocks, and I say nonsense. Fed involvement and Fed liquidity is the mother's milk of stocks, and I'll extend that to just about everything else too. You mentioned how gold and the dollar sometimes are absolutely correlated the other way, because in times of stress, it was always supposed to be that money flocked to the dollar, U.S. Treasuries, gold, the yen. So that's all done right now, it seems like to me. And until further notice, you want to believe 2024 comes back? I'll say maybe to that. Right now, I think the dollar and the Fed is the whole game, and everything else, that's the dog. Everything else is the tail, if that's the expression.
Yeah, no, I hear you. And I think we have an FOMC in about 13 or 14 days, a couple of weeks. And then the ECB isn't until I think February 22nd. So it's going to be behind us. So we're going to see some push and pull here around those events.
So one thing too, Andrew Bailey, the head of the Bank of England, came out the other day and he said he believed that inflation was rapidly declining, were his words. But the market is still pricing in their 10th consecutive tightening in the Bank of England, and that all comes in around the same time as the FOMC and the ECB. So I think it's interesting. As you said before, they seem to be a little more hawkish than the Fed, which I agree with. And I think, again, the Fed is going twice more, 225 basis points. I don't think they're going to go again. And I think the funny thing that I find interesting is if you look at the Fed funds curve and it says the Fed goes two more times for a total of 50 basis points, and then the Fed eases at the end of 2023. Here's what I contend with. What is that if they are going to turn and start easing, it's going to be in a time of panic. And it's not going to be that gradual 25 basis point ease that the market is predicting. And I rarely disagree with the market because I always consider that the smart money. And I do agree with the first part of it. But I think if they go to ease, it's going to be quicker than 25 basis points.
So interesting that you say that. So, I look at that the CME Group Fed funds tool all the time, right? So we're tracking 92% chance of a 25 basis point hike for the next meeting. And then a terminal rate, I'll use the word terminal rate at the next meeting for another 25. You compare that to some of those dot plots in December and October, that's way bearish.
Yes. Yeah. And the market disagrees with the dot plots considerably. And again, the Fed's job is difficult, but when we parade these guys out, if they're in the midst of a tightening cycle, they can't talk down their tightening cycle. The market has to, by just the nature of the relationship, do that for them. We've talked about this before. In reality, we shouldn't even know who these Fed guys are. The market should just be telling us what they think. When they started to become rock stars, that was very, very detrimental to the market function, in my opinion. So but the market's saying to me that the Fed can come out and say all they want about terminal rate being 5.25, and the market's calling this on them. I know that we try to keep good language on this show, but the market's saying the bull, and the market's saying you're going to have to ease, and I go with the market.
No, I hear you. And I think there's a part of, hey, I'm going to deliver some bad news, and if I'm wrong, I'm going to look good. As opposed to I'm going to deliver some good news. If I'm wrong, I'm going to look bad. So I think there's a little bit of that.
It's a psychology. Yeah, I love what you're saying there. It's just the psychology of humans compared to the market psychology, which is just the thousands and thousands of participants coming up with a solution.
Yeah, for sure. Well, we definitely have to cover the E-mini S&P, because this is,
no doubt about it.
We have wildly different projections across, the talking heads on TV about 3,500, 3,000 ES at the end of the year versus, 4,500, 5,000. It's crazy how divergent these views are.
Yes, I agree. And this chart, all those other charts look great to me. This chart does not. It fails at the trend line and at the 200-day moving average. That's if there is a failure today. So, and it seems so. It's lost quite a bit, right? I know I sold it just before I came up here.
Let's see. We're tracking 40.05 right now.
Yeah, and I just sold it, which I'm kind of proud of, just because it seemed to be failing right there. Now, if the euro moves higher tomorrow out of that pattern, if gold moves higher tomorrow out of that pattern, these things can't coexist. We're not going to have a big down day in the stocks and have a big up day in the euro. So this is the something's got to give moment. And that's why I put my caveat with the euro as it has to continue strength tomorrow. Now, that's not going to happen if the stocks are getting kicked in the teeth. So it's a long day ahead of us too. If the stocks can recover and start to stabilize above that 200-day moving average, perhaps make another new high tomorrow, near-term high tomorrow, then I can be convinced that they're solid up move in the stocks. But as I said, right now, just before I came on, I sold small and put a stop up above there because I don't think it's going to happen quite yet.
Yeah, and what's not lost on me anyway, I don't know how you feel about this, but yesterday's body of the candle was really, really small, almost a doji. Today's body of the candle is really, really small with big wicks up and down on both days, is telling me there's just a lot of uncertainty right now, even with the numbers that came out today.
Right. Indecision. So you just got to look for, and so we're giving forth all these clues as to what could change this indecision. But for the moment, it's absolutely indecision. And even, by the way, even in that euro pattern I was talking about with the 2 outside days in a row, that's an indecisive pattern. It's got to be the solution, the resolution to that changes that to something. And I'm hoping that happens tomorrow. And either all these things happen. The stock's got to recover. If the euro does that tomorrow and breaks out to the upside, the stocks necessarily have to follow it if my thesis is correct that everything is basically following the Fed.
So we need continuation buying in the euro tomorrow to set the pace.
That's what I'm thinking. Yeah.
Yeah, it's interesting. It's even my financial advisor is giving me the I don't know, Jim. Makes me a little worried. Well, you're supposed to be the pro. You're supposed to know more than me, which is not hard, by the way. In any event. So, and then yesterday the Dow took it hard, right, with Goldman's earnings.
Yeah, and I was long Goldman too. So they're not all winners. Where's the Dow on here?
I'll pull it up. Hang on a sec. We could do that.
Yeah.
YM. Take a second here. Pull it up with NinjaTrader software. Expand the chart. We're good to go.
Yeah. So it's a totally different pattern than E-mini S&P, which I find is interesting though. But it's still it fizzled out right at those the highs from the candles from the first week of December, right in there. Fizzled out there.
Yep.
It doesn't look any better to me. This looks like if I had to pick a direction, gun to my head, I'd say lower. You?
Yeah, no, I agree. Let's see what other earnings are coming out. This is there's only 30 components here, right? So when one or two of the big ones are out of whack, everything gets out of whack on the stock index, for sure. But these are all Bobby's EMAs I have up here, or moving averages, and they're all kind of clustering together right here.
Right, good. So it says that there's the rotation zone, they call that, those two moving averages, it's between now. So it should be in a little bit of support there. But if it breaks through that, then all of a sudden it could have, a serious move lower. By the way, those moving averages that Mike Arnold and Bobby use, and we go over them on the Futures Edge podcast quite a bit, are really, really impressive in my opinion. And I didn't come up with them; they did. I wish I did.
Yeah, no, it's okay. It doesn't matter who comes up with them as long as they're helpful.
Amen. Right. Good point. Yeah.
So I don't know. We'll see what from an economic release point of view, though. Really, I think the next set of eyeballs is on the Fed meeting. I think, is there a CPI between now and then? I don't even know. It might be after that.
No, there isn't, and that's one of the reasons that I have on these call flies to the upside, because I believe it's going to be a gradual trade over the next couple of weeks, and I'll make a little bit of money on the theta on those. So I'm kind of agree with you. There's not much to look at the next, which is funny because with how hyperbolic I am, every time it seems like I sit in this chair, I'm like, this is the most important day. But no, when you look at the next 2 weeks, there's not a lot coming out. I do think that the Euro chart, again, that's something that I'm excited about, which again, maybe it's just the coffee.
No, I'm excited about it too, for sure. I mean, my opinion is it's always been about interest rates. Everything is about interest rates. And it really was magnified in the last year and a half, post-COVID. Yep. It really magnifies that. And I think it's always going to be a phenomenon.
I do too. And I think, again, and that's a shame that the Fed has become so activist that they have such control in so many different assets. But again, as traders, we can opine about how terrible it is and how we wish it was back to where the market just established price, but we get what we get. We're not on the Fed. We just have to trade the markets we're given.
Well, man, we just, time kind of flew here. I do want to remind folks how to get a hold of you, and I won't muff up the Futures Edge podcast ever again because it's my favorite.
I got that. Yeah, right. Okay. Yeah. Did you hear the last one with Doomberg, by the way?
I have not heard the last one yet. No, that's I will listen to it though.
It was pretty intense, but you can follow me on Twitter at Jim Urio, JIMIUORIO, and the Futures Edge podcast with me and Bobby Iacchino. And the best part about the Futures Edge podcast is not me and Bobby. There are some really outstanding guests that agree to be on it every week, and I would appreciate if you guys give it a listen.
Awesome, for sure, and I'm gonna ditto that as well. So thanks for being with me here today. Greatly appreciate it. Looking for next time.
Thank you, Jimmy. See you guys.
All right, everybody. Thanks for coming. I do want to remind everybody, please, most important message of the day: be safe out there. Be good to each other. Thanks for coming.